Hi friends, let us discuss about risk management and Basel, particularly Basel. So, first of all, let us abroad about risk management. First, every company must have an estimation of risk for each and every project so that they can have total risk they are going to face. Every company have a risk tolerance. For example, one person can bear a risk of 10 lakhs, person can bear at a maximum of 1 lakh. It is their risk tolerance. So, in case of companies also, they have their risk tolerance based on their cash reserves and their establishment. So, all the companies want to face risk less than their risk tolerance. So, that's why they estimate risk. So, when they allocate funds to different projects at the same time, they go on allocating risk limits for each and every project. That is called risk budgeting. So, those projects individually can't breach that risk limit, so that the total risk the company going to face is not more than the company's total risk tolerance. That is the way of designing. We can have a separate video on this risk management. It is better to concentrate more on Basel. I think there are two types of risk. One is endogenous risk. This is somewhat internal because of our actions. Another one is exogenous risk, out of which we don't have any control, just we need to face it. We need to forecast, face and cover ourselves from this. We are using various types of instruments. So example of exogenous risk is interest rate risk. Endogenous risk example is credit risk, operational risk, liquidity risk. These are all fall in endogenous risks. Then let's see what are these risks. Credit risk, the chance of losing our credit, right? Then off balance sheet risk. There are some items that fall in off balance in our banking business. For example, guarantees, letter of credits, all these fall in off balance. So these are not reflected in balance sheet. That's why they are called off balance sheet items. So I already discussed about this in another video. So these off balance sheet items don't impact balance sheet until unless a event happens. If, for example, I gave a guarantee of 10 lakhs on behalf of my friend, if he defaulted, then those 10 lakhs will become liability in my balance sheet. So these are called off balance sheet risks. Interest rate risk, as we said, it is a exogenous risk. So all we need to do is we just need to face it. Forex risk, say for banks nowadays increasingly dealing with forex. In such a case, if there is a heavy fluctuation, for small fluctuations banks are ready, they can handle that, but in case of heavy fluctuation there will be a loss. Sometimes of course there may be a chance of gain also. Say for example, in case of Pakistan, if we have lot of Pakistani rupee in our bank account, if all of a sudden Pakistan went into blacklist from grey list, its rupee get devaluated. So our reserves of Pakistani rupee is of no use. So such is a negative risk. Say other way around, if we hold US dollars, then all of a sudden US dollar value went up. Yeah, it is a positive effect. Then liquidity risk. Liquidity, solvency, both are cousins. Liquidity is for short terms, like to below 12 months. Solvency is for long term. So unable to face short term needs is liquidity risk. Unable to face long term needs is solvency risk. To give a better example, all we bank employees have better liquidity. We don't have liquidity risk because we get income on monthly basis. So in a month we get a income, so there is no problem on monthly basis. But so we have solvency risk because by the end of our tenure we generally acquire very less property. Because of that we don't have much property by the end, so it is very difficult to manage at the end. So that is long term and that is solvency risk. But business people generally have liquidity risk. They always struggle to manage day by day activities, but they earn a lot by purchasing flats, properties and investing in the business. They earn a lot. So in long term when arranging a marriage or celebrating something, they can spend more than us, like 10 to 15 times. We can't spend that much. We took a personal loan and all other loans OD, and we are in such a way. So ours is a patchwork in case of solvency. In case of daily, we maintain a car and everything, somewhat overreaction. So coming to awesome aspect, Basel. Basel is a awesome city in Switzerland. So for brainstorming purpose, all this financial, intellectual do this brainstorming at Basel. So BIS, Bank of International Settlement, established in 1930. They come first with a capital account for banks in 1988. This is considered as Basel. BCBS, Basel Committee on Banking Supervision, came out with this capital account for banks, that is Basel in 1988. India adopted it in 1999, just 1 year before 2000. That's why we need to remember it. In this, only credit risk is considered, no other risk is considered. Capital to risk weighted asset, that minimum requirement is considered to be as 8%. Then comes Basel II. Basel II occurred in 2008. It is called International Convergence of Capital Measurement and Capital Standards. The discussion started from 2004, but it finalized by 2008. It have three pillars. One is minimum capital requirement, second one is supervisory review process, third one is market discipline. So this financial system stands on these three pillars. So in minimum capital requirements, there are calculation of minimum capital requirements, credit risk, market risk, and operation risk. All these are handled. So yeah, what is operational risk? The risk that is arised out of our functioning, the way the organization is functioning. Say for example, a employee committed a fraud, that comes under operational risk. Say for example, a failure in computers, that is a operational risk. So all these are falls under operational risk. Then there are three types of capital constituents. So tier 1 is permanent shareholders equity and disclosure reserves, nothing but shareholders equity. And disclose, there are some reserves every company holds. If they are disclosed, they also fall under tier 1. Then tier 2, these are undisclosed reserves, revaluation reserves, general provisions, hybrid capital instrument. What is the example of hybrid capital instrument? A convertible bond which can be converted into share. So hybrid capital instruments, subordinate term debt. Subordinate term debts are which are not secured by any collateral. Okay, so these fall under tier 2. What are general provisions and legal provisions? Say for example, some person filed a case against your bank. So bank makes some provisions so that if the case went in favor of that person, they can pay him immediately and it won't affect that financial year results. So in such a ways, these reserves all fall under tier 2. Then tier 3, short term subordinate debt fall under this. So there are some rules. Say for example, your tier 1 capital is 100 rupees. So in such a case, the tier 2 capital can be maximum of 100. It should not cross 100 rupees. Then tier 3 can be 2.5 times. That means can be maximum of 250, not more than that. And subordinate debt, total subordinate debt should be less than 50 rupees, total 50 rupees. Minimum capital requirement is 8%, that means 8 rupees, and tier 1 need to be 4%, that means 4 rupees out of each 100 rupees. Then Basel II, in case of pillar 2, in supervisory review process, the process is for particularly for better risk management. It have some principles, 4 principles are there. One is, all principles state only one thing. Capital adequacy ratio is already, there should be a process to assess capital adequacy ratio. Supervisors should review and evaluate banks' internal capital adequacy. They must maintain the regulatory capital requirements and they must act early. Supervisors should not act after the breach, they must act early, not reactive, proactive. They must act proactive. That is the principle 4, that is very important. Then these are 4 principles that fall under pillar 2. And finally pillar 3, it gives market discipline. That means all the disclosures that the bank must do, that fall under pillar 3. Coming to Basel III, it came in 2010. India started adapt it from 2013 to 2019 in phased manner. I don't think it haven't yet completed by now also. So according to this, minimum capital requirements is 8%, tier 1 is 6%, and there are some additions to each and every pillar. We already discussed 3 pillars in Basel 2. So there are some additions. Instead of studying everything, what are the differences? What are the additions for Basel 3 is pillar 1, Basel 2 plus liquidity management is added for pillar 1. For pillar 2, Basel 2 plus firm wide risk and capital planning and capital management is added. Pillar 3, enhanced risk disclosures are added. This is the advanced version of Basel 2 with some additions. I hope this is of use for you. If any doubts or advice for me or any clarifications needed, just drop a message. Have a great day.